the annual picture really tells what's going on here. So in essence, what's happening is Yelp is essentially replacing all of its accounts on an annual basis. And we can kind of just walk through the math. So we have an image for 2015, we have a chart for 2016. So what we're doing here is we're comparing the starting and the ending customers in each period, and then comparing the total number of new accounts signed during those periods and the total number of lost accounts signed during those periods. So what you can see here is that in 2015, started with 84,000 accounts, picked up 93, lost 66, ended with 111. Now, if you compare those lost customers to what they started with, we can't explicitly call that an annual attrition rate, because it is possible that some of those lost accounts were actually came from accounts that were signed intra-year. But given that most of those accounts that they sign are on annual terms, most of that churn can't happen from intra-year accounts, from accounts that they signed intra-year. So we can't explicitly call it an attrition rate, but for all intents and purposes, that's what it is. And we can repeat the example for 2016. They ended 2015 with 111, so they started 2016 with 111, picked up 113, lost 86, ended with 138. Once again, you compare what they lost to what they started the year with, and they're basically suggest that they're losing the overwhelming majority of their customers on an annual basis. And the other thing to consider is that if you compare the new customers that they signed to what they ended with, it basically suggests that whatever they're reporting in any given period is comprised mostly of accounts that they signed during the year. Now, the question is, why is all of this happening? Slide 14. It comes down to ROI. And I want to warn everybody that as far as what Yelp throws out there for ROI metrics, you really can't trust them. And what we're showing you here is the footnote, which we've expanded off to the right, and I want to show you how they're estimating revenue. So estimated revenue is from leads from ad clicks times average revenue per customer. So that is leads, not conversions. So by assuming that revenue based off of leads, you're assuming 100% conversion off those leads, which obviously doesn't make any sense. So now if we go to slide 15, we get a little bit more detail as to how they're coming up with these numbers. The thing that we have to consider here is that those leads are not mutually exclusive. Yelp is actually double counting them in certain situations, right? So all you have to do is take a look at the customer leads breakdown, which we've highlighted in the black box on the first chart. Look what's in here. You have clicks to the website, you have mobile calls, you have deals sold, you have mobile check-ins. All of these are not necessarily one person. You can click on a website, make a mobile call, and then look for directions to the establishment, right? And if you look over to the chart to the right, we've also highlighted in that black box exactly how they calculate this. Each customer lead is assumed to be a unique visitor. So all this said is that the ROI metrics that Yelp is throwing out there are obviously misleading, if not intentionally misleading. One. And two, here's the funny thing, is that we don't actually know how many of those leads were acquired via advertising or were just organic to begin with.